Welcome, everybody, to stage 6 in the business cycle. You're watching the Stock Market Brief Show. My name is Michael Silva. We got an action-packed episode with a ton of charts that we have to go over. We're going to talk about the stock market cycle, the business cycle. We're going to go through prior bear markets to see how price action responded. Then, on top of all of that, we're going to go over expected moves for the week coming up, the month, and we have the quarterly expected moves to give you some updates there. So buckle up. It is going to be action-packed. Let's get into it. All right, everybody, welcome back to the show. You've probably seen this chart before. I've showed it many times. Orange is the stock market cycle. Blue is the economic cycle. We are going to focus right here at the stock market top, where you see energy, consumer staples, healthcare, utilities. This is where energy performs the best typically, and as it starts to turn, these start to perform. And as we all know, well, if you look year-to-date performance, energy was a leader, right? Still is as of right now, even though it's coming off hard and fast. And we have utilities making the turn, consumer staples, and then healthcare right there. So that's matching quite well to the stock market cycle. So what's next as we progress through? Well, we start to hit a top in the business cycle. And, well, as we all know, the Fed is tightening. And, well, if we raise rates now, we can lower them to stop the recession the rate hikes will cause. Yeah. All right, so let's get into the business cycle. Business cycle, stage 6. Why am I saying this? Well, I'm going to stick to stage 6 right here. 1, 2, 3, 4, 5, 6. If you want to screenshot this and read over it, please do. Stage 6 is when bonds, stocks, and commodities all go down. Stage 5 was when commodities were still going up, but bonds and stocks were going down. Does that sound familiar? Because commodities have been ripping, but now all of a sudden, commodities. A lot of red throughout the screen on these 1-month percent change and 3-month percent changes. Commodities have been getting obliterated. Now, stage 6 marks the deterioration in the economy as the business cycle prepares to move from a expansion phase to a contraction phase. So stocks have already been moving lower, and commodities now turn lower in anticipation of decreased demand from a deteriorating economy. Okay? I mean, come on now. Like, who can argue that that's taking place right now? And then what happens, after stage 6? Well, we go back to stage 1. What's the difference there? Well, that's when bonds start turning up, but stocks and commodities are still down. This shows the economy contracting and bonds start turning up as interest rates decline. Economic weakness favors loose monetary policy and the lowering of interest rates, which is bullish for bonds. Okay, so as we're seeing right now, we don't have loose monetary policy. We are walking through a tightening cycle right now. And we already know, yes, commodities are down. Bonds have been going down. We saw a little bit of a hoorah right here, but then the last 3 days, they start coming down. So this could take a while to either base out or may potentially even have another leg lower. All right, so this shows that we're in stage 6, and we'll talk more about, what's, the Fed a little bit later. Before we do, let's just go ahead and look at the S&P 500 previous times that we've seen bear markets. Now, bear market is defined as a 20% drop from its peak. This is dating from 1950 to 2019. I'm looking at minus 20%, and you can see here, this is intra-year peak to trough drawdowns. Okay, 13 times from 1950 to 2019. So first and foremost, it's very rare to happen. It also happened in 2020, and it's happening now. Okay, so very rare, and it's created obviously some good time opportunities in the market. But can the market head lower? Because some of these drawdowns went even further. Well, as we know, we reached bear market territory. We're kind of coming out of it right now. I posted this chart on Twitter to see how the stock market reacts, how people react when we get into bear market territory, minus 20%. You can see the 20% level is actually, kind of important. We see a lot of bounces from that level, then we try to get back above it and recoup it as fast as possible. Take a look at 2020. This is the S&P 500 in 2020. This was one of the more fastest moves to the downside, and it quickly recouped. And as soon as we got outside of it, that was the note telling, professional traders and many people that, hey, the bull market, we reclaimed the bear market level. This could be where we start taking back off again. And sure enough, it was. It's easy to see that in hindsight. Same thing happened to the NASDAQ composite. Let's take a look even back further, 2018. Look how important the minus 20% level was right here from peak to trough, right? And the way that I do this is you just take the high and you times it by 0.8, and that'll give you a 20%. It'll give you the number right here. And you could see we tagged into it perfectly, and we started ripping up from that point. Okay, continue on. And there's reasons for all of this too, by the way. Same thing with the NASDAQ composite. Went a little bit deeper and got outside of it, and look at where it pulled back into that level, and then we started ripping higher. S&P 500 going into the financial crisis was a little bit different, right? You could see here we tagged a few times, very similar to how it responded just recently, and then we kind of came within it right here, and we just started drifting higher before a more of a downside took place. And then when we started getting out of the bull market, when we could be out of the bear market to be more long bias, which not to say that we couldn't be more bullish down here because the Fed stepped in. But you can see here we tagged it, we drooped a little bit lower, but we finally came back in, and that's when the bull market really started kicking back into full force. NASDAQ composite, very same situation. We doodled around, and it took a long time to get back and recoup those levels. Let's go back in time even further to the dot-com bust. The dot-com bust, you can see here, we had a high. This is 20%. We came basically pretty deep within it. We try to recover. Hallelujah. That big bear market rally ended up getting completely faded. This is, September 2001. This was during the terrorist attacks. And you can see we saw a lot more downside there. And we did have the Fed step in eventually. If we go to the NASDAQ composite, this one looks absolutely insane because of the big tech run up, right? The big dot-com bubble. And you can see from here to here, that was 20%, got it's just completely massacred, and we tried to come up a few times to recoup that level, but we didn't actually reclaim that level fully until around 2014, and that's when we started obviously seeing more of a market rally. Okay, and something very interesting too about the S&P 500 during the dot-com bust. Look at, it took a long time to really recoup this level, and it was in 2006 is when we really recouped this bear market. The 2001 dot-com bust, and then we already know what happens shortly thereafter going into 2007, 2008, right? Shortly thereafter, we went into a financial crisis. Let's go back in time even further. How did this respond in the 1990 stock market crash? This right here was the peak to trough. Look at this, 20% level, tagged it, and we were off to the races. Pretty similar to 2018. And guess what? Both times had a Fed pivot. NASDAQ composite typically drives in deeper because, it's more tech focused. You can see here, boom, came outside of it, hung around, big move to the downside, and look at how it responds to that minus 20% level. Wasn't ready, but this gap up here, right here, and then we were just off to the races, okay? So coming out of that bear market territory is, in fact, important. At least that's what we see now. Let's go back even further. Let's go to 1987. Look at 1987. This is, absolutely insane price action. That's why we're showing you this, is just to give you an idea of the price action. This was obviously Black Monday, where we saw already big crash, but then we had Black Monday, boom, right there. And it wasn't until we started getting out of that minus 20% level when the market started taking off again. So once again, it is an important level to watch. What was the NASDAQ composite doing? Well, NASDAQ composite also, yikes, to the downside. But when we got back above it, look at what held, that minus 20% level from the peak here, from the high, from the 1987, right before the 1987 stock market crash. So once again, this minus 20% level is the reason why I'm pointing this out, is not to say, hey, this is going to be another 2008 financial crisis. I'm pointing this out because, one, it does look very similar from a price action perspective around the 20% marker. Okay, so what do I mean? Well, 1, 2 tags, then we started drifting higher in around July. That's very similar to what happened in 2008 as far as the price action goes. If I go back to 2008, where is it? Right here. Nope, not right there. That is 2001. Right here, 2008, you can see we came down to the 20% level a couple of times, and then in July to October, we started lifting up a little bit higher, right? It really matches seasonality to a perspective, okay? So that is just to give you an idea of, keep an eye on that level. It's an important level because when we come back outside of it, maybe, we doodle around a little bit longer and we're above it right now. So that is actually somewhat bullish in the short term. But just be mindful that if we start coming back down into that minus 20% realm, also go back to bearish bias, be more cautious. Now, why is this important to point out? And let's look at a longer term chart, okay? So this is the quarterly time frame. We have a quarterly 5 EMA on here. And the reason why I'm pointing this out is because very rarely do we have a quarterly candle close below the 5 EMA on the quarterly basis. We had one close just recently, and price action is still below it, okay? Almost every time that we had a quarterly close below the 5 EMA, right here, right here, right here, right here, right here, and I'm going to skip these two to talk about them momentarily. And then we also had, the 1987 one right here, and then the 1990 one right here, okay? Those are important. Why are they important? Well, because the Fed had stepped in every single time during those quarterly close below the 5 EMA. And the reason why I'm bringing this to your attention now is because the Fed is still in a tightening cycle. The Fed was in a tightening cycle. All right? And then the Fed over here did not step in till right around here. They announced it, but then they started doing QE1, QE2, right, or Operation Twist. Then we had the China stock market turbulence. This was the repo crisis. This is unlimited QE. All right? What was this here that pretty much kicked it all off? Well, I have the data for you. This was in the 87 to the early 90s. Okay, so what took place there? Well, 2 months after Alan Greenspan took office as Fed chair, the stock market crashed, right? We just said that in 1987. In response, he ordered the Fed to issue a one-sentence statement before the start of trading in October. The Federal Reserve, consistent with its responsibilities as the nation's central bank, affirmed today its readiness to serve as a source of liquidity to support the economic and financial system. Boom, go ahead, there's your buy signal, right? And what do you know? The very next quarter, we started trading up. Okay, what about the 1990? That was 1987. That was right here. Right? Boom, to the downside, and bam, we started recouping that level. We had 1, 2, 3, 4, 5, 6, 7, 8 quarters just straight up. All right, very similar to what we see here. 1, 2, 3, 4, 5, 6, 7 quarters straight up. All right, and then what about the 90s? The 90s stock market crash right over here. Okay, well, in response to the bursting of the 1990s stock market bubble in the early years of the decade, the Fed lowered interest rates rapidly. What do you know? All right, okay, cool. So we started ripping and gripping. All right, so everything's going so well. So in 2000, Greenspan raised interest rates several times. These actions were believed by many to have caused the bursting of the dot-com bubble. And then in 2001, as a decisive reaction to the September 11th attacks and various corporate scandals which undermined the economy, Greenspan-led Federal Reserve initiated a series of interest rate cuts that brought down the federal funds rate to 1% in 2004. Just take a look. We just ran up like crazy, and then we started raising rates, popped the bubble, then a war started, the terrorist attacks, then the Fed started stepping back in, and then we started obviously ripping up higher once again. And then what takes place? Bam! Financial crisis. The financial crisis, right? This cheap money drives speculation, just like unlimited QE drove a bunch of speculation. So my point in telling you all of this is because the Fed right now is being very hawkish, meaning they're being very direct, and they're telling us that they have a path to lower inflation. And to do so, they will be raising rates. When will they pivot? I don't know. Nobody knows. No one knows, okay? You can have guesses and estimates, but as it stands right now, they are hawkish, and they will be raising rates. Total assets, you can see, it was going parabolic up, starting to flatten out here to go down. Markets like liquidity. They do, all right? So if the Fed continues this path of tightening, are we going to see, the David Hunter melt-up without the pivot? Like we saw here, like we saw here, we saw here, we saw here, we saw here, we saw here. All right? But during these times, it took a while. It took a while. I'll leave that up for interpretation for anybody, but it's something to be aware of. Now, where is the quarterly 5 EMA? And we're still below it. It's at 4,064. Remember, bear markets, they have big bear market rallies. All right, so what do we have going on the calendar next week? Okay, the ones in red, those are high impact to the market. Every other one, that's mediocre impact, okay? 2 stars versus the 3-star reds. Okay, and we have inflation rate year over year. understand that inflation rate, the consensus is that it's going to be higher than what it was the prior report. Consensus is 8.8. The previous was 8.6. So if it comes in at 8.8, that's still record high once again, or, in quite some time, more than 25 years. So we'll see here and then we'll also see if consensus is wrong and we're actually even higher than that. I think that we are close to being at a peak, but I think we're going to get another high reading. And then maybe perhaps at that point, because we're starting to see commodities come down, then we're going to start to see the rate at which, inflation is moving to slowly move down. But I don't think it's going to be some dramatic level. I think by next year, we can still be around 6%, Q1 of next year. We'll see. Okay. The Fed is constantly saying right now that they do not forecast a recession. Very similar to how over here they were saying inflation's transitory. All right. So if they said inflation's transitory, then they said that they're wrong. Now they're saying that they don't believe, that there's going to be a recession, which technical recession is defined as two negative quarters of GDP. I don't know what they're talking about. And you just look at the Atlanta Fed GDP now is forecasting a recession. This is now, it was down at around -2%, and now it's at minus 1.1. So chances are we're going to get a negative print here at the end of July. And then on top of all of that, we have inverting curves. That's not good. When is that good? It's not. It's actually forecasted every recession. So there's clearly some structural things that aren't, doing too well. The 10-year and 3-month, the Fed staple over here, has not inverted, but holy moly, it's heading straight down. If we take a look at now the monthly timeframes to give you an idea of where do we stand in all this? Where are some key levels? Well, the options market this quarter priced in a move to a potential upper range of around 4,300 and to the downside around 3,400. That's for the quarter. For the month, it was posting right at around 4,100 to around 3,600. That's an expected move based off of implied volatility. Okay, so where are we right now? Well, in the S&P 500, we're coming outside of that bear market territory, but we're still under a declining 5-period moving average, and you can see here that the 5-period EMA is actually in line with the monthly upper range. So even if we start moving up even more, as everyone's saying that this is the stock market bottom, okay, cool. They may be right. They may be wrong. We still have wind at our face here, and we're still in a downtrend. Okay, that's the reason I like these bigger time frame charts is because it cuts out a lot of the noise. Okay, where is this line here? That's going to be in confluence with the declining 5 EMA. That's at 4050, so 4,050, which is also in line with the quarterly 5 EMA, which is also declining. If you take a look at the Qs are still in bear market territory. We are just at the monthly expected move, and it's only the 9th as I'm recording this right now. So around 305, and then we have the monthly 5 EMA that's declining still, and it's been acting, boom, as resistance. And keep in mind, too, this is the most frequently tagged EMA. Tag, 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 and then this month we have not tagged yet. So even if we start moving up higher, bam, that's right around the expected move with the options market price in, and 309.11, which is the declining monthly 5 EMA. All right. Continue on to the IWM, also deep into bear market territory right here, starting to see a little bit of a bid, wind at our face of the PPO, RSI is pointing up slightly, declining 5 EMA, and you can see here, even if we were to go on a rip up to the upside, the options market is pricing in for the quarter, and it could be wrong too, it doesn't need to be always accurate, but even the quarterly expected move is still in bear market territory, even if we were to run up that far. And we'll reevaluate if price does. But right now, as it stands, yeah, we're catching a little bit of a bid. We're disconnected from the 5 EMA, and we're coming back up to potentially tag it. If you take a look at the SPY on the weekly time frame, I just want to point out here, you're going to hear a lot of people say this move was on decelerating volume. They are accurate. It is on decelerating volume, but remember this last week was a shortened trading week. All right. And we did recapture the 5 EMA here, which is actually more of a bullish tone than anything. So that is something from the shorter term perspective that's actually quite bullish. Same thing with the Qs, decelerating volume. The PPO is flattening out to trying to curl itself over. We recaptured that 5 EMA, and you can see, yes, declining volume. However, it was a shortened trading week, and we kind of have this bullish divergence divergence that's kind of playing out right now. So still a lot of work to be done, but on the shorter time frames, it's looking somewhat constructive. If we take a look at the SPY, this was last week. Last week's expected move. This is why they're important. Look, it came down, gap down on Monday, basically tagged it, and then ripped right up. Now, we've been saying that, hey, based off of seasonality, right? We said July 1st, bullish day, most bullish day of the year. Okay, we moved up. Then we said based off of seasonality, you typically get a run up to around the 10th ish area. And that's exactly what we're seeing right now. Okay, and I'll bring up a seasonality chart here momentarily. But what's the expected move for next week? Expected move has a higher high and a higher low. You can see it's coming up to right around this gap fill over here. And to the lower edge, it's basically, right here where there was prior support, prior resistance. That's right at about 380. That is what the options market's pricing in. 15-minute time frame, we are above the inclining now 5-day moving average. So the short-term bias is still bullish at this particular point in time. If we start heading up higher, look for this gap to be filled, and that 397 is the upper edge of the expected move. That could definitely have an area of obviously some supply overhead, okay? And by supply, I mean, understand this upper expected move. Actually, you know what? I'll talk about that in the NASDAQ composite area. If we take a look at the Qs is breaking out of this downtrend line. It closed outside of its weekly options expected move. And you can see over here, we have a higher high, higher low, and we're tagging right around that 50-day moving average. So if we start moving up higher to around that 305, guess where we're at? Well, we're right here at where this previous price action was, where there is definitely some trapped supply, and you can see there's previous resistance there, and then we broke down hard and fast with some distribution days. So if we get up here, that level can be a strong level of resistance to continue to monitor. We did break this downtrend, so that's a positive sign, but you got to just be aware that, hey, we still have lower highs and lower lows at this particular point in time. If you take a look at the 15-minute time frame with the 5-day moving average, bullish bias, because, well, we are still above that 5-day inclining moving average. Until that changes, well, we'll let you know. But as it stands right now, bullish bias here in the short term. Very short term, right? 15-minute time frames. Once you start breaking out the larger time frames, we're obviously bearish. So there's these counter trend rallies that take place. I want to show the NASDAQ composite now. We are on day 14 of the attempted rally. We've been showing this on Twitter. I've been showing it multiple times here. And there's something very important that I want to point out. So we had 1, 2, 3, 4. On the 5th day, we had a follow-through day, which is a day where we move up more than 1.25%, more than 2% on inclining volume, more than the prior day. So that was our follow-through day. But that was quickly followed by a little bit of weakness, and then bam, bam, 2 distribution days. Distribution days is when we have the market go down on increasing volume. So right there, right then and there, it shows that there's some supply up in this area because we were starting to get distribution. And then if you just look to the left even further, well, guess what? That's where all that chop was. And then we had a massive distribution to the downside with some big heavy gaps. All right. So the reason why I'm pointing this out now is we're starting to see that seasonal rally take place. But if you look on a daily time frame, right, we talked about the weekly declining volume because of a short trading week. But take a look here. It's just declining, 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 declining as we're moving up. This right here is consistent with a bear market rally. Now, look at volume could come in, and then all of a sudden we get a big blowout type of day. That would change the narrative here. But while volume is contracting, be very careful, because if we have a distribution day, which there's already research out here that, hey, if you get a distribution day, within 2 days after a follow-through day, the new low there's a 95% chance it fails. A 95% chance it fails based off of history, okay? So I'm just pointing this out that if we do have a distribution day, watch out for the higher volume day and a move to the downside, okay? Now, from a bullish perspective, I'm going to go over some indicators now. From a bullish perspective, we did get that buy signal right here. So there's a lot of bearish things, but in the short term, like I said, it's still bullish. Okay, so we got that CPC to cross down through the 10 period. That activates the buy signal. The last 2 times that happened, all right, we had a little bit more of a squeeze to the upside before it petered out. And this was the Santa Claus rally, which we talked about, and boom, moved to the upside there too. Okay, so hey, is there more upside in this rally? Hey, it's very possible, right? We will see here what the CPC prints come the next day. And another couple good things, we have the NASDAQ summation index on our side for the bulls. So short term is bullish. The indicators are saying short term is bullish. The short term time frames, they're saying that they're bullish. So this is how bottoms are obviously, found, but that doesn't mean that something can't happen. So we got to still be aware. Okay, so the summation index for the NASDAQ, it's moving up. Where the parabolics are under it, it's pointing up, still well below zero. So that's also just a little bit of a warning sign. If you look at the summation index, New York Stock Exchange summation index, we talked about the positive divergence and the parabolic SARs underneath it and still heading up there too as well. Then a couple other bullish things is the BPSPX. It's not overextended to the downside and it's not overextended to the upside. So we're kind of just curling up here, pointing up above 50. So that's not necessarily bearish or bullish, but it's more bullish than bearish because it's pointing up right here and we're above 50. So it's starting to head up here too as well. If we look at the seasonality chart, what typically happens, as we previously discussed, Democratic midterms, you get a run up into around, the 10th, 11th, 12th, middle of July, and then you start to see some weakness. And then it picks up a little bit in August, which, they call this the summer doldrums. And then we see a big hit to the downside going into September. So that's a strong possibility, seeing that we're in the Democratic presidential midterm. Okay. Another bullish thing, though, 200 weekly moving average is holding on the broader index, the New York Stock Exchange. So that's currently holding. There is a gap beneath this that hasn't been filled. So we'll see here if it gets filled eventually. But that's positive. And even if you look at something like the Wilshire 5000, the Wilshire 5000 is, a huge composite, a really good, overall look at what's taking place in the markets. That's holding that 200 weekly moving average. And it looks like it's wedging here, expanding, contracting, looking like it can potentially break out and try to create some sort of a rally here in the short term. So also a positive thing. And then we have the NASDAQ composite. Take a look. The 200 weekly moving average is also holding. Okay, so short-term charts are looking bullish. The longer-term charts are holding up, all right, at this particular point in time. So things seem to be going well at this particular time, but in order to really see big changes, make sure that you're paying attention to those smaller time frames. From a negative perspective, I want to just remind everybody that volatility is still high. Okay, the RVX, this is Russell volatility, it's still above 30, and NASDAQ volatility, it is still above 30. These are the areas where we can see big swings in the market. I've looked at charts like the VVIX, volatility of volatility. I've looked at skew. It shows that it just seems like a lack of hedging is taking place. So if we get sell side activity in these markets, and we get people that have to sell into that selling or hedge, it could be downright wicked to the downside. So we need to be very aware of what is taking place. That's all I got for you on today's episode, everybody. See ya.